On Friday, April 24th, the Justice Department ended its criminal investigation of the Federal Reserve chairman. By Monday, reporting made clear what the decision meant. The last procedural obstacle to confirming a new Fed chair was gone. Jerome Powell's term ends on May 15th. His replacement, Kevin Warsh, was nominated in January. A single Republican senator, Tom Tillis of North Carolina, had held up the confirmation, refusing to move it forward while the Powell probe remained open. On Friday, the probe closed. On Tuesday, today, the Federal Open Market Committee meets. It is, in all likelihood, Powell's final meeting in the chair. And the question everyone in Washington is asking in quieter rooms, the question the markets are pricing, the question Elizabeth Warren put in 4 words at WORSH's hearing 3 days ago, is whether the next Fed chair will be his own man or the president's man. This is not the first time a president has picked a Fed chair he wanted. It has happened before, twice in ways history remembers clearly. Once in this country, once more recently in another. Both times the president got the rates he wanted. Both times the country paid. This is what that cost. Before we go back to 1970, we're going to 1974. A family in Cleveland that bought a gallon of milk for 60 cents in 1971 paid $1.06 by the end of 1974. A tank of gas that cost $4 before had doubled. Paychecks rose, but never fast enough. A dollar saved in 1971 had lost roughly a third of its value by the time Nixon resigned. Gas stations closed at noon because they had nothing left to sell. Lines wrapped city blocks on odd, even license plate days. Grocers printed new prices on cardboard signs because the old ones were wrong within a week. This was the beginning of what economists now call the Great Inflation. It did not end in 1974. It ran grinding until 1982. It took 2 recessions and unemployment near 11% to break it. The man who could have prevented it was the chairman of the Federal Reserve. His name was Arthur Burns. He had taken the job in February 1970. The man who gave him that job was Richard Nixon. On December 10, 1971, 11 months before Nixon's re-election, the chairman of the Federal Reserve picked up a telephone and called the President of the United States. The conversation was recorded. It lasted a few minutes. And in that call, Arthur Burns did not ask the President for his view. He reported in. Burns, I wanted you to know that we lowered the discount rate, got it down to 4.5%. Nixon. Good, good, good. Nixon White House tapes, Conversation 1682, December 10, 1971. That is not how an independent central bank is supposed to work. Here's how it got that way. Arthur Burns was not a Nixon loyalist when he took the job. He was an economist, University of Chicago, then Columbia, a former head of the National Bureau of Economic Research. He had advised Eisenhower. His reputation was his currency. In August 1971, Burns was in the room at Camp David when Nixon made the decision that defined his presidency's economic legacy. The United States ended the convertibility of the dollar into gold. Wage and price controls were announced the same weekend. The post-war monetary order, built at Bretton Woods in 1944, was finished in 3 days. Then came the election year. Nixon wanted growth. He wanted cheap money. He wanted unemployment low and the stock market high and the economy humming all the way to November 1972. And he told Burns so, in person, by phone, through intermediaries, and, as the tapes like the one you just saw document, relentlessly. Burns wrote in his private diary, published decades later, about feeling the pressure, about Nixon's insistence, about moments when he questioned whether he still controlled his own chair. The Federal Reserve cut rates through 1971 and held them low through 1972. Money supply grew. The economy roared. And in November, Nixon won 49 states. Inflation arrived in 1973. By 1974, it was above 11%. By then, Nixon was gone, resigning in August over Watergate, not over monetary policy. But the damage was set in place before he left. It took Paul v. OHL Care, a decade later, raising the federal funds rate to roughly 20%, to break the back of the inflation Burns had accommodated. That is the American precedent. For a more recent one, we leave the country. Recep Tayyip Erdoğan had an economic philosophy. He believed, contrary to virtually every mainstream economist on earth, that high interest rates caused inflation, rather than controlling it. And he believed the Central Bank of Turkey existed to deliver lower rates. In July 2019, he fired the governor of the Turkish Central Bank, Murat Çetinkaya. Çetinkaya had refused to cut rates as fast as Erdoğan wanted. In November 2020, he fired the next governor, Murat Oysal. Same disagreement. In March 2021, he fired the third governor in less than 2 years, Nazi Bal. Bal had held the job for 4 months. His offense was raising rates by 200 basis points to fight inflation. Erdoğan fired him within 48 hours. The fourth governor, Şahap Kavcıoğlu, understood the assignment. He began cutting rates even as inflation climbed. What happened next was what every economist outside the palace predicted. The Turkish traded at roughly 7 per US dollar at the beginning of 2021. By late 2023, it was trading in the high 20s. Turkish inflation, officially, crossed 85% in October 2022, the highest in a quarter century. Independent measures from the ENA Group researchers suggested it was higher still. A Turkish pensioner who had saved in lira for 40 years watched roughly 3/4 of their lifetime savings, measured against the dollar, disappear in under 30 months. A cup of sea meat, sesame bread sold on every Istanbul street corner, rose from 1 lira to 6 in the same window. Families who could convert their savings into dollars or gold did. Those who could not, the majority, absorbed the loss. Erdoğan got the rates he wanted for as long as he wanted them. In 2023, after his re-election, he quietly reversed course and appointed a former Wall Street economist, Hafize Erkan, and the hikes resumed. By then, the damage was compounded. Turkey is still recovering. 2 presidents, 2 Fed chairs, 2 countries, 50 years apart. 1 pattern. Now the pattern is in Washington again. Kevin Warsh sat in front of the Senate Banking Committee on April 21st, asked directly whether he had been pressured by the president to commit to rate cuts. He answered, "The president never once asked me to commit to any particular interest rate decision." Take him at his word. There is no recording, no diary, no tape to suggest otherwise. Yet, there is an honest case to be made for Warsh. Fed independence is not a constitutional doctrine. It is a convention, built after the 1970s precisely because of what Burns allowed to happen. Presidents have always influenced the Fed, from Roosevelt to Johnson to Bush. The question has never been whether a president has views on monetary policy. The question is, what happens when presidents get exactly what they ask for? Twice before, presidents got exactly what they asked for. Nixon got the cuts and the growth in the 49 states. Erdoğan got the cuts and the growth and the re-election. Both got what they wanted, both paid, and both made their countries pay, on a delay. In Washington today, the Federal Open Market Committee is meeting. The statement drops at 2 in the afternoon. Jerome Powell, in all likelihood, is delivering his final press conference as chairman of the Federal Reserve. Kevin Warsh, if the Senate moves as expected, takes the chair in May. What we have learned, from Nixon, from Erdoğan, from every president who leaned on a banker and got his way, is that the bill for a compliant central bank does not come due in the same quarter it is issued. It comes due in a year, or 3, or 10. And when it comes due, it is paid by the people who never got to vote on the rates. History doesn't repeat itself, but it sets a precedent. Subscribe to Precedent for new episodes every Tuesday and Friday. Turn on notifications so you don't miss what's next. History doesn't repeat itself, but it sets a precedent. We'll see you on the next one.